Hi everybody, and welcome back to Your Real Estate Quest, where we're helping on your real estate journey. We are gonna talk about bills and stuff. I'm not excited. No, I'm kidding. It'll be a lot of fun. We've got Kevin back. Tell me again what your title is, because I feel like I messed it up every time.
So my technical term is mortgage loan originator.
Okay.
And licensed, which is a little bit different than bank loan officer.
Okay. We'll probably get into that a little bit. Thank you so much for coming back and talking with us. Gonna apologize in advance. This might actually span into 2 episodes because as I was writing down questions, it turns out I don't know much about anything, and so I have a lot. Thank you for your patience.
You bet.
So why don't we start with can I use lender? Is that appropriate?
Yeah.
Okay. So what do lenders do? How did you come up with this 3,500 that we've been kind of using for this process?
For the payment?
For
the 350,000.
Yes.
So as a lender, as a mortgage loan originator, lender refers to everybody in my office, my whole team, from processing to underwriting to closing to funding. But my job is up front. So my job is to collect enough information, it's not formal, and to determine what loan amount and sales prices you qualify to. And in addition, to see what you're comfortable with paying and what that turns into for a sales price. So my job is to draw the map for everybody else within my office, for you, for the real estate agent, so that they know where we're going and how we need to get there.
Okay. I like that. That's a nice, concise summary. So how do you mentioned that you are a licensed originator, right? That's the word?
Yes.
Okay. How did you become one? What are your qualifications? Right. How does that differ from bank? Was the other one? Okay.
So I've been doing this so long. I was a loan originator before we had to be licensed. But after the crisis in 2008, they required everybody has to be registered with the federal government. It's called NMLS. I won't go into the details. But if you work for a bank, so a Wells Fargo, a Chase Bank, a credit union, where they're a national bank, the bank assumes the responsibility. So they don't have to take any classes, they don't have to be bonded, they don't have to have E&O, they don't do continuing education every year. The bank takes the responsibility. As a mortgage loan originator, I work for a bank, but we only do mortgage loans. So we don't do deposits, we don't do CDs, we don't do personal loans, car loans, we only do mortgage loans on improved property. So the difference between, go ahead.
What does improved property mean?
Improved property means a piece of land with a house on it.
Oh, okay, not a house that has been made better.
Right, no.
Okay.
Just it has to have a house on it.
Okay.
So there are land loans out there. There's construction loans, and we can get into that some other time.
Yeah.
But we do
Eventually.
residential mortgage loans. So there has to be a house on the property. And so the good thing about a mortgage loan originator that's licensed is they're taking continuing ed every year, and they're bonded, and they have E&O insurance. They have to have background checks done. And so it's a little more stringent than a bank, and a lot more stringent than before when nobody had to do anything. You could just go out and do mortgage loans. But that was a long time ago.
Mm-hmm. So one of the other things that I was wondering as we're talking about this whole process, do I have to use you as my lender just because I picked Haley as my agent?
Absolutely not. A matter of fact, that would be illegal for anyone to require you. You're free to shop, and that's what the government wants, is you to have access to all the information. The problem is there's so much information, and if you don't know what you're comparing, it can be misrepresented. So the good thing about working with the lender that partners with the real estate agent is they have a working relationship, and they know how each other works, and to make sure that everything goes smoothly. It's also important to have a local lender in your current market. Sellers like that, sellers agents like that, and they know your market. So It's not required. You can shop on the internet. You can look anywhere you want. But in my opinion, you need to interview them. You need to ask them questions because they say that you need to know them, like them, and then trust them. And most of all, trust them.
Okay. Kind of like we talked about in episode 2, I just want to make a note of this. When we were talking about how to pick your agent, we talked a little bit about referrals from a friend. So I am just going to kind of reiterate that note that sometimes a referral from somebody you already work well with is a good, at least starting place, because they work well with that third party, they work well with you, you and that third party are likely to work well together.
Right.
But not always. On that, are there specific things that one should look for when looking for a lender?
So, in my opinion, I think you want them to be licensed, not just registered, because they're the most up to date. It's kind of like a doctor. Do you want a doctor that's not doing continuing education, or do you want a doctor that is? I prefer one that is. So, but then you want to interview them. You want to ask. Make sure they're looking out for your best interest. So for me, I never look at loan size, sales price. What I'm looking at is what do you want to do, and how do we get you there? And often we can do it right now. Sometimes we have to create a plan, and I follow up with you through that whole plan. So the key is to surround yourself with a real estate professional, a realtor, a lender. I would say you want to talk to before you go out and start looking at houses, because if you get pre-qualified for $350,000, but you were out looking at $600,000, you're probably not going to be able to find what you want, because you're going to be comparing it to that.
That's actually one of the things that I had later on. What is a pre-qual?
So a pre-qualification, it's a very informal process. There is no cost, there is no commitment. At least with our company, we do a soft pull on your credit. So I don't even do a hard pull. So it doesn't affect your credit score, it doesn't do anything. But it just gives me enough information to determine loan amounts, sales price, and programs that are available to you based on your particular income, your particular debts, how much money you have or do not have for down payment and closing cost.
Okay. How do you know those aspects of the numbers? How do you know closing costs and down payment? I think we talked in episode 1 is relatively flexible.
Right.
In a little bit, I do actually want to deep dive into the different types of loans, because there's so much more out there than I thought there was. This is such a bigger deal than I thought it was going to be. But how do you know what closing costs are? How do you factor that in?
That's actually a great question. Standard closing costs, this is for third-party fees, okay, before any lender fees. This is just third-party fees. You're looking at about $3,500, depending on appraisal, title, and stuff.
Okay.
But then there's this term called prepaids, which a lot of lenders don't tell you about that, because they want to just say $3,500. But it is required. It's your first year's homeowner's insurance and taxes. So the standard that I usually tell everybody is $8,500 is your closing cost. And that's going to be the same pretty much across all of your loan programs, except for a couple we'll talk about later. Anything over that, the lender is charging you some kind of fee to get you that interest rate. And so that's why I said it's hard to kind of tell if you're just comparing interest rates and not comparing interest rates and closing costs.
Tell me if this is too broad scope for what we're trying to do here. How do the interest rates just get like plucked out of the air? Who does that?
So interest rates, contrary to what most people believe, have absolutely nothing to do with the Federal Reserve and what they do. I always tell people the Federal Reserve, it's not what they do. They control rates that they charge their member banks on overnight loans. So it affects short-term loans, credit cards, auto loans, home equity lines of credit. Nothing to do with mortgage rates. Mortgage rates follow mortgage-backed securities on Wall Street. So that's why there shouldn't be big variances in interest rates, because we all get the money from the same place.
Okay.
We all follow the same guidelines. There could be small variances in overhead and things like that. But mortgage-backed securities are what determine interest rates. So when everybody hears the Fed just lowered the rate 0.5%, that doesn't mean our rates went down 0.5%. I kind of compare it to an iPhone. If a new iPhone was coming out in 6 months, the stock for that phone, or for Apple, would probably go up. So when the Fed hints that they're going to raise or lower interest rates, the market already builds that in well before they do it. So it's what the Fed says more than what they do. And then it's what those investors on Wall Street think about what they did. I'll give you an example. When they just did the 0.5%, the markets thought that was too much, that we still have inflation, and that it might be politically motivated. And so mortgage rates actually went up, even though the Federal Reserve lowered rates.
Okay, so if the rates are controlled not by the Federal Reserve, but by this
Mortgage-backed securities on Wall Street. They're bonds.
Okay. Why, when I drive around town, do I see signs that say rates as low as?
Right.
And there seems to be a larger discrepancy. So if they're all controlled by the same thing, where is that coming from?
So that's why you have to compare apples to apples. They can advertise rates as low as, but they're not telling you what they're charging you to get that rate or who's going to be paying it. So loan program makes a big difference. VA, FHA versus conventional. Down payment assistance loans. All of those have different rates, and all of them have pros and cons. And so that's why you want to look and see what the buyer is trying to accomplish. What's the best one for them? And then you give them all the options. You don't just give them one and then you explain to them, this is why I think this one is better. This is what I'd do if this was my loan. This is what I'd do if this was my child. So you want to find the loan that's best for them, not best for the loan officer.
Okay. So in the little bit of Google research that I did before I just got really overwhelmed and thought, no, I'll make Kevin talk about it instead. I kept coming across a term, discount points.
Yes.
What does that mean? That seems like it's monopoly money or something.
So remember I told you standard closing costs are $8,500. If your costs are coming to higher than that, there's probably discount points. And what that is you are prepaying at closing to buy a lower interest rate. I give people this example all the time. Generally, paying discount points is not in the favor of the buyer. It's in the favor of the bank. The only time I normally tell people to pay discount points is if somebody else is paying it for them. The builder, the seller, if the lender's giving them for lender incentive. Otherwise, for every discount point you pay, you don't even break even for 5 years. So, and the average person is in a house maybe 5 to 7. So discount points, it's those bankers. They're always going to be in the favor of them. So you're prepaying the interest so that they can quote you a lower interest rate.
Okay. So with Hollywood Magic in the last episode, we submitted an offer. If it goes through, we sit down, we do the whole actual loan process, allegedly. Does all of that get explained? Is it just a line that says discount points, $57?
Right.
Or I assume it would be way more than that.
And this is where it's important that you have talked to and interviewed a lender and you're comfortable with them, because you don't know what those discount points would be until you're issued what's called a loan estimate, which is part of your loan. But people want to know before they actually write a contract, what's my payment going to be, as close as you can get it? How much money do I need? And do I qualify? And if you can answer those 3 questions, but I always start out with no discount points. And then I give the buyers the option, not me. I say, if you want a lower rate, here are ways you can get it. You can pay for it. We can ask the seller to pay for it. Doesn't mean they will. Depends on the market. But there's different ways we can get it. But I start every loan out with what I call the par rate. That means you're only paying the closing costs we're getting charged for. You're not going to pay for the interest rate.
Okay. this is a question I should have asked earlier, but I didn't totally think of it. When, say I'm working with Haley, she says, I know Kevin, he's great, you should go talk to him. When she sends me to you and I say, yep, Kevin's great, I want to work with him, does Haley get some sort of, like, I don't know.
Kickback?
I was going to go with, like, referral.
Oh.
But.
No, that's absolutely illegal. I cannot pay a real estate agent, or anyone for that matter, for referrals. Because the government thinks that we just pass that on to the consumer in the form of a higher interest rate. So no, that's absolutely illegal. Matter of fact, I'm not supposed to spend more than $25 on a lunch, even with a realtor, unless we both pay. That would be considered a violation of the RESPA law.
Which I'm guessing is do you want to just?
Yep, it's the Real Estate Settlement Procedures Act. It means that I can't pay Haley, I can't pay a builder, I can't pay anybody for referrals. The only way that I get their business is by doing what I say I'm going to do. And the communication part of it and making the process smooth and efficient and seamless. But there can be no money. And on the other end, if I refer to Haley, who is a great real estate agent, I can't pay her, or she can't pay me. No one can pay anybody for referrals.
Okay. Weird.
Now we can do things that will benefit the buyer. I can pay whatever I want for the buyer. She can do whatever she wants for the buyer. As long as our transaction, everything benefits the buyer, then we're okay.
Okay.
But we can't do anything under the table or on the side.
Okay. I've got one more kind of what I think is going to be an umbrella-ish question, and then we'll like pause for a second because I think that'll be a good point to if I have to split this, so that we can do the whole put your information up. What is APR? Because I've been told it's not your interest rate.
Right.
It seems like it should be.
Right. I used to hate APR, but these days it's one of my favorite terms because it is one number that a buyer can take and compare amongst lenders to show whose loan is really the cheapest. Earlier I said that they can charge discount points and you might not know it until you're under contract or right before closing. So a loan estimate will show an APR. That combines the interest that you'd pay over the full 30 years plus anything you paid at closing, all calculated as one number. So if I say I'm at 6.25 and someone else says they're at 6, but when you look at our APRs, mine might be still 6.25 because I'm not charging fees, but with their fees, they might be 6.375. So it was designed so buyers could look at one number and determine who the cheapest is.
Okay. So when you're seeing things that are interest rates as low as, that's referring to that interest and then the APR, which will still be a percentage.
Right. And it'll always be higher than the rate.
Okay.
Because it includes closing costs.
Okay.
And technically, by law, if you issue a payment or you issue an interest rate in any type of marketing, you're required by law to put an APR on there. Because it's easy to say, it's done on the internet all the time, hey, we're at 5.5 with no points. But then when you get your estimate, you're saying, well, what's this sure fee? That's just the discount point renamed. So APR is a great number. If someone it's all about price, and I know people are price conscious. That's not always the number one thing, but they should always be close. But if someone is showing a rate much lower, I guarantee they're charging some fees and the APR is going to be the same or higher. And I give people the choice. Do you want to use your money now or not? How long are you going to live in the house? So it's not just about the transaction. It's about the relationship.
Okay. Thank you. Like I said, we're going to pause quick I'll do an awkward episode cut because we're not really cutting, but I think we will. So yes, I'm going to wear the same clothes next week. It's fine.